The question is, what causes inflation?
Yes.
Everyone's very upset about inflation in the United States. Now the headline inflation, the consumer price index, is 8.2%.
Yes.
The core inflation last month, if you take away energy and food prices, is going up, and it's at 6.6%. Shelter, which is a big part of the consumer price index, is up from 6.2% to 6.6%. And what they call core services, that takes the energy and food out of there. Core services up big time, 6.1, and it moved up to 6.7% last month. The core goods inflation is down just a little bit. So we're kind of switching now. We had most of the inflation started showing up with goods, commodities that you would buy. And now it's morphing kind of over and switching into services like, hospitality, your haircut, all of those things are services. The money supply started growing when COVID hit in February of 2020. And what happened? We were all locked down, so you couldn't buy a lot of services. The stores were all closed.
Right.
So, but at any rate, that is a typical pattern. It starts with the commodities, and after you get an increase in the money supply, you have commodity prices and asset prices start going up with a lag of about 1 to 9 months.
Right.
And what happened this time? The money supply starts going up in February of 2020. Of course, the stock market started booming. The oil prices went up. Soybean prices, corn prices, all the grains went up. Livestock prices went up. Housing went up right away, started zooming. And then we have another lag, and all of a sudden the real economic activity kicks in. That takes about 6 to 18 months after the sustained increase in the money supply. And then ultimately, we're talking about inflation today, that comes with a lag of about 12 to 24 months. It's very long, the lag. They look at what's going on with the money supply today, and there's a lag between that and changes in asset prices, changes in real economic activity, and ultimately changes in inflation. So that's the transmission mechanism, and that's a tricky thing because of these lags that we're speaking about. Now, you mentioned hyperinflation, and
yes,
and this also gets back to the cause of things. The Minneapolis Federal Reserve Bank has done a couple of studies. They're a little bit dated, but very revealing. They looked at 110 countries and tried to see if there was a relationship between changes in the money supply and changes in inflation. And from 1960 to 1990, the relationship is 1 to 1. If you increase the money supply 1, you get a 1 increase in the consumer price index, 110 countries. Now, I just completed, in anticipation of speaking to you, I wanted to update this. So we have a bigger data set. I'm glad you're seated. We have 157 countries that we looked at from 1990 to 2021. And again, that relationship is almost perfect, 1 to 1. Increase money supply by 10%, you increase inflation by 10%. Decrease the money supply, if that should happen, and you decrease in a 1 to 1 relationship. No, inflation is not global. It's homegrown, it's always local, created by changes in the money supply in a particular central bank. For example, we have the Federal Reserve, the United States. That is the epicenter of what's happening with changes in the money supply created by the Fed and the commercial banking system in the United States. The UK, the Bank of England determines that. The Eurozone, the European Central Bank does that. Now, let me give you the examples, and these are important. Right now we have inflation In the United States, 8.2%. It's a little higher in both the Eurozone and the United Kingdom. It's 9.9 in Great Britain right now.
Okay.
Look at this. Japan, what's the inflation rate? It's 3%. It's not global. It's not global. And that's because of the Bank of Japan's controlling the money supply. They haven't exploded the thing like they have in the United States, Great Britain, and Europe. Switzerland, inflation is now 3.5% per year. They've controlled, the Swiss National Bank controls the thing. Of course, the winner out of the whole thing is China. China is following the quantity theory of money. They know the changes in the money supply affect inflation. Their inflation in China is 2.5%.
Right. Yeah.
They try to. And they are different. They are different than the United States in the sense that they have exchange controls. So that is a big impediment. They don't have a freely floating exchange rate because they have exchange controls. And one reason, by the way, that the Chinese yuan is really not an international currency like the US dollar is because they have exchange controls. So yes, but in the context of inflation,